So let's start with Australia. I mean, what can you say? The Australian economy is very strong. They don't call Australia the lucky country for nothing. Right now, your interest rates are low. You've got an easy money policy from the Reserve Bank of Australia. You've had a smooth transition from the JobKeeper program. There was a lot of concern that when that benefit ended, that perhaps people wouldn't be able to get jobs and consumption would dry up. That has not happened. The job market is strong, and so the JobKeeper kind of did its job, has gone away, which is good from a fiscal point of view, but that was not disruptive. Australian retail sales were down a little bit in the last month, but still positive, and they're expected to grow as the vaccination program spreads. So Australia got off to a little bit of a slow start, but catching up fast. So again, that's moving the country towards what epidemiologists call herd immunity, and we're not at the end of the pandemic, but certainly I would say the end is in sight, and Australia is making good progress there. A couple other points that are important to bear in mind. Australia has one of the lower debt to GDP ratios of any developed economy, meaning your national debt divided by your GDP, that's a percentage. The US is sky high. I'll talk more about the US, but Australia is in a very good position. It has a sustainable debt to GDP ratio. What that means is if you need fiscal policy help, you can get it. You have headroom to run larger deficits and expand fiscal stimulus. I'm not saying that Australia will need it. What I'm saying is if you need it, you've got the headroom and you can do it without some of the negative consequences that we are seeing in the United States. So that's another plus. Inflation's low, which means if you need monetary stimulus, you can get it. Again, if inflation's running out of control, central banks have to rein it in. They can't provide easy money forever. They can do it for short periods of time, but if inflation is on the horizon, you might have to rein in your monetary policy. Again, that's not the case in Australia. Inflation is very well behaved, and you have room for monetary stimulus if you need it. Despite the kind of de facto trade war between China and Australia, China's acting like a bully, cutting off certain imports from Australia, most famously wine. But the fact is, Australia has what China desperately needs: coal and iron ore. So, okay, maybe you're not selling as much wine to China, but coal and iron ore exports from Australia to China are running close to all-time highs. China is stimulating its economy the way they always do, which is with debt and construction. They're very good at building things, that whether they need everything they're building, whether they're wasting that debt on white elephant projects or train stations with 128 escalators that are mostly empty. Who knows? But they're doing it. That's how they drive ahead, because they don't really have a consumption-driven economy. They have to have an investment-driven economy, and if the investment's wasted, that's a problem for another day. But in the meantime, keep the steel mills going, keep the electric generators running, and they do that with coal and iron ore from Australia. So that's another strength. So on the whole, strong growth should continue. The central bank has said they're going to continue the QE for a while longer. They haven't set a deadline when they'll cut it off, so-called tapering, but at least through September, possibly later. You've got room for larger deficits, and you're going to have some tax relief. So I don't like to sound like Pollyanna. If I see problems, I'm the first one to call them out. But Australia just is kind of hitting on all cylinders right now. Strong comeback from the pandemic, strong recovery, and room to grow, room to take this further, both in terms of fiscal and monetary policy. So sort of all good on Australia. There are three vulnerabilities. Again, I don't want to suggest that nothing could go wrong, but there are three things that could go wrong that Australians need to bear in mind despite all the good news. The first one, and this is critical, is a slowdown in China. Because Australia is so dependent on exports to China. If China slows down, Australia slows down. It's as simple as that. For the time being, we're coming up July 1st on the 100th anniversary of the founding of the Communist Party of China. That's a very big deal, centenary. China's determined that nothing can go wrong between now and July 1st. So nothing will be allowed to go wrong. So I would expect for the next few months, at least, everything will continue. But after July 1st, they're going to have to face up to some of these problems, including perhaps a new housing bubble, over-leveraged, bad debt, wasted investment. They don't want to do anything right now. But later this summer and certainly later this year, you might see the Chinese economy slow down. That could be a little bit of a headwind for Australia. A bigger headwind, which I'll talk more about in a minute in a lot more detail, is the U.S. slowdown. It's not so much that Australia exports a lot to the United States. There's some exports, of course, but it's kind of a triangular trade. Australia exports raw materials to China. China does the manufacturing, and the U.S. consumer buy the Chinese manufactured goods. Well, if the U.S. slows down and we buy less from China, China's going to need less from Australia. So it's a kind of a bank shot if you want to think of a billiard table. But Australia is indirectly vulnerable to a slowdown in the U.S. because if we slow down, China slows down, and then that affects Australia. So, and the third thing I would look out for, asset bubbles. Good news is good news. That's fine. But if housing gets too hot, if the stock market gets too hot, those things have a way of correcting. So, again, applaud the good economy, good fiscal monetary policy. Weathered the Chinese bullying in good form. So a lot going on in Australia that's very positive. But watch out for asset bubbles, particularly. And again, I'll talk more about this. If the U.S. stock market's in a bubble, which they are, and I'll be specific about that, and there's a severe correction later this year, which I expect, then that could affect Australia as well. So right now, fundamentally, all good on the Australian economy. Exports booming to China despite the bullying by China. Jobs are plentiful. Housing prices are going up. You have room in fiscal monetary policy, but watch out for a Chinese slowdown later this year, a U.S. slowdown later this year, and maybe some severe corrections in our stock market that could have a ripple effect in Australia. Let me switch now to the pandemic. Of course, that's the biggest story in the world for the last 2 years. Things are definitely improving. It's not over, but it's getting much better. Caseloads and certainly fatalities are dropping precipitously in the U.S. and Australia. This fourth wave, which we saw in the U.S., is abating very quickly. There is a world, the world numbers are sort of three waves: an initial wave last spring, a strong wave last winter, and then a new wave right now, which is the worst of the three, primarily driven by caseloads in Brazil and India. But that is tailing off. Interestingly, when I wrote my book, The New Great Depression, it was kind of half economics, half the pandemic, epidemiology, and virology. And so I did a deep dive on the science here. And one of the most interesting things I discovered is that these waves take about 8 to 10 weeks. They're very predictable. Hard to predict exactly when and where they're going to break out, but when they do, you can predict a downslope after about 8 weeks.